Welcome to the Infra Insider, the podcast that explores the global renewable energy and infrastructure sector. Join us as we dive into insightful conversations with industry leaders, pioneers, and visionaries shaping our world. It's no secret that the financial markets have been in turmoil over the last 12 months. Inflation has been uncontrollable, with interest rates soaring, and many of the large funds have struggled or have been struggling to raise finance. Then again, the infra and renewable space is incredibly resilient. And my guest today is going to shed some light on the challenges and opportunities in the renewable energy and infrastructure markets. I am therefore delighted to be joined by Martin Krastev today, Head of M&A at IDCM, a leading M&A and debt advisory practice. And today we'll be discussing the M&A market, understanding the challenges, understanding the opportunities. Having placed Martin at IDCM and built a team, I'm in a really fortunate position to have spent time with him and to get to know him. But I don't think that I will be able to introduce him in the same way that he can introduce himself. So Martin, welcome to the show and over to you.
Hi, Daniel. Thank you very much for the invite. It's a pleasure to see you, as always.
Absolutely.
And it's even more pleasure to discuss the topic today. What can I say about myself? I joined IDCM in 2021 to build the M&A practice of the firm. Until then, IDCM was debt advisory boutique. And I can talk about IDCM a little bit more in a second, but before I joined IDCM, the previous 7 years I spent at DC Advisory in the infrastructure team. I helped Sergio Ronga, who was the head of the team, and also the rest of the team to build it up to what became one of the largest and most successful infrastructure advisory teams in London. And I think they continue to be very strong in the sector. Sergio and I go back probably about 15, 16 years. We worked together at Macquarie Capital, where I started my career in investment banking in 2007. We were in two different teams. Sergio was head of debt advisory at Macquarie. I was in the power and utilities team, which then, after the financial crisis, it became the infrastructure team at Macquarie Capital. And then Sergio moved to DC in 2012. I went to actually an infra fund in 2012, and then we decided to work together again in 2014. So I joined DC in 2014, we were very successful for the 7 years prior to 2021, and then
absolutely.
In 2021, Sergio decided to do something else. Neil Marvin, who is another person, from the very beginning at this advisory, took over from Sergio, and I had a very good relationship with Neil, but Neil wanted to do something else with the business, and I was in a crossroad, and I had a lot of different options in front of myself. Continue with DC, follow Sergio with whatever he was doing, join a client. I had approaches from a few of my clients, and I decided, this is the time when I was turning 40, and I decided to do something else in my life and try to be a little bit more entrepreneurial.
I was the lucky person, and IDCM as well, who managed to bring you into the business. And I know there's been some incredibly exciting things coming up, and some amazing deals that you worked on, which will all be announced over the coming months. But thank you for that introduction. I mean, you've got a wealth of experience over 14 years. I just counted then, and I think that it's what's great is you've come from DC during a period of buoyancy, but also coming in when there was difficulty in the financial markets. How does the renewable energy and infrastructure M&A space compare to back in those days when you started out at DC to now? where we are in today's market post-COVID, but coming into a financially challenging market?
Yeah, and I think the short answer of this is that everything is bigger today, not just in size, but also the scope of the infrastructure is much larger than what it was 15 years ago.
What do you mean by that?
Let me explain. Well, not the sectors, the type of assets, right? So if you go back to the 2006, 7, 8, infrastructure was pretty much regulated utilities, water, gas, and power. A few type of transports, airports, roads, ports, and this was pretty much it. Renewables was just emerging as an infrastructure asset, but it was very small and very narrow. And if you look at where we are now, we have a whole new sector, which is digital infrastructure, which includes towers, fiber, data centers. But even within the other subsectors, the utilities, we now have, non-regulated utilities like district heating and other non-regulated utilities. You have assets like oil storage, gas storage, smart meters. So the type of assets which qualify as infrastructure is much broader range these days. And this, you can say the same thing as for renewables. So renewables was a pretty small subsector of infrastructure back in 2007, 8, 9. And it was limited to subsidized projects. So it was predominantly projects, operational projects, solar, actually wind, predominantly onshore wind. Solar and offshore wind became actually first offshore wind in the UK and Germany, then solar. But again, predominantly projects and predominantly subsidized projects. When then kind of the subsidies started fading out in 2016, 17, 18.
Was that just for the UK market, or are we talking, the global market, or are we just talking Europe?
Europe. I'm talking about Europe. Yeah.
Okay.
I'm talking about Europe. I mean, UK is a big chunk of the European renewables market, especially, if you talk about certain technologies like offshore wind. Obviously less so for solar, but, Europe-wide, I think subsidies started fading out 5, 6, 7 years ago. But there was a period of time when, getting infrastructure fund, getting comfortable with merchant risk was very, very difficult thing. There was only a few people doing it.
Tell us more about merchant risk, because not everyone listening to this is going to, fully understand and appreciate what that is.
I think if you go back to the beginning of the infrastructure, the beginning of the renewables industry, building a project or the marginal cost of energy produced by a renewable energy project was very expensive compared to coal and gas power. And therefore, the government to stimulate the growth in the industry, the governments had to subsidize it, to provide a subsidy. A lot of these subsidies came in the form of feed-in tariffs, meaning that the revenues, at least the tariffs were fixed, so there was no power price risk. There may be volume risk, but there was no power price risk. In other countries like the UK, for example, the government subsidized some projects in the format of traded certificates, like ROCs, which to a large extent had a fixed price with a very small component of the price being volatile or merchant. And if you look at the overall revenue stack, a very small portion of the ROCs type assets was volatile. Majority of the revenue profile was fixed. by a government subsidy. These subsidies in the very beginning, they didn't have a cap. Then the governments woke up to the fact that they need to have a cap. Then they eventually imposed caps. Also, these subsidies kind of got reduced over time to a level where now there is no subsidy. And if you want to build a renewable energy project today, you entirely depend on the securing power prices which the markets dictate at the moment. Now, you can contract this through a PPA, power purchase agreement, with either a large utility or a large user of electricity, which will de-risk this merchant component of the power price. But I think when we talk about merchant power, to a large extent, we refer to a project which is not subsidized by a government.
Okay, listen, thank you for that detail. So looking at your kind of career through those 14 years, we started talking about, what's changed. So what's clearly changed is there's now more subsectors within infrastructure and renewables. It now seems like there are less government incentives, such as the ROCs that you talked about there. And therefore, it seems like we are, for the last sort of 4 years, the market's been kind of propelling and building momentum. So I suppose those are the differences. Do you feel that with more sectors and more subsectors, that's making it easier to do deals, or is it making it harder to do deals? And as a business, as IDCM, which of those subsectors do you prefer to work on?
Yeah, I mean, can I just make one correction actually, because there's one other very big difference,
Okay, no, thank you.
Between now and going back to the great financial crisis, 2009, 10, 11. And I think this big difference is, what I was saying earlier, renewables at the time were projects, predominantly operational projects.
Yeah.
And I think it was very rare where an infrastructure investor was taking development risk or buying a corporate which was developing assets. And I think the big development in the last 5, 6, 7 years is that investors not only got comfortable with taking more merchant risk, but also taking on more development and construction risk.
Did they get more comfortable, or did they have to take that risk to increase yields?
Yes, I mean, it's a combination of both, really. So I think with capital becoming more available for infrastructure projects, I think there was need in the market for investors to invest in opportunities which require ongoing investment of capital.
Okay.
So if you go back to the kind of the second wave of funds, the funds with vintage after the financial crisis.
Okay.
A lot of those funds required ongoing cash yields. Yeah. But the later, the later in years of vintage year of the fund is, the less demand for yield was needed. So we saw funds which were entirely focused on greenfield projects. Yield was not the main focus, and they were getting higher target returns through growth and funding growth. Now, you are correct that the only, with more availability of capital and cheaper capital, yield, target returns were suppressed, and the only way investors to get to the double-digit returns was to fund development pipeline, construction risk, and more growth. So I think both of these arguments are correct.
Yeah, and I suppose there's also an argument to say that people probably want a higher return now, especially with interest rates being so high. You know, that I think in the UK as of today, they're at 5%. So I suppose any investors are going to be looking for, you know, significant returns, and obviously by taking that development risk, we've seen that come through. Now, what I think would, for the listeners, would be interested to understand is where do you think, of all of these technologies, both in infra and renewables, where do you see real momentum for investors for the sort of the next 12 months? Where do you think most of the transactions are going to be happening?
Yeah. Look, I think there will be transactions happening across all the subsectors. And this would be driven by another dynamic in the industry, which is that a lot of the funds which were raised post the great financial crisis, you know, in the period of 2013, 2017, a lot of these funds, which were 10, 12 years funds, are now coming to maturity. So whatever they invested in 10, 12 years ago, they now need to divest it. And this would be a big driver for transactions. So, just, funds realizing their assets and materializing their carried interest. This will be one big driver, and these transactions, as I said, the top of these transactions will be to a large extent driven by what funds used to invest 10, 12 years ago. The other big driver is what we see in the what we see happening in the economy, which is not just renewables, but the wider energy transition theme.
Yeah.
And energy transition is different from renewables. You know, maybe we can talk about this also, what's the difference. But the wider energy transition is a big value driver and deal flow driver. And the other big kind of theme is digitalization, right? So digital infrastructure.
When we talk about digital infrastructure, again, can you expand on that for the listeners who might not have come across that? I'm sure everyone has done, because everyone listening is probably involved in infrastructure and renewables. But if you can, you know, from your perspective, what does that sector really look like? And maybe even an example of some deals that have happened across the space recently.
Yeah, I mean, usually when you talk about digital infrastructure, this means three type of assets, 3 or 4 type of assets. We're talking about towers, telecom towers. It could be broadcasting, but more and more mobile telecom towers, predominantly driven by the 5G technology, which requires much more infrastructure than the 3G and 4G. Fiber infrastructure, and this is either fiber to the home or backbone fiber, and data centers, right? So,
okay.
And the demand for more infrastructure comes from the exponential increase in data flows and data storage requirements in the industry. So, with and the demand for data is driven by the consumer habits, people watching Netflix and moving away from traditional TV.
Are you watching anything good at the moment?
I don't have time to watch Netflix.
Oh God, you don't. Sorry, I couldn't resist. But maybe you can let me know afterwards. I'm looking for a new series.
But the other thing that you need to so demand for data is driven by both end user habits, like watching TV and video clips on their phones or through through internet, but also infrastructure itself now generates and consumes more data. And a good example for this is, for example, all the smart meters that we have installed here in this country, but also in Europe. This now generates huge amount of data which needs to be stored and analyzed somewhere, needs to be transported. We're now talking about, reading the smart meters on a half-an-hour basis.
Yeah.
Which, if you go back 10 years ago, I mean, we were, if someone was reading the meter once a month, that would be, quite often, right? Now we're talking about half-an-hour meter reading and analyzing where this electricity or energy is consumed. How it is consumed, why is it consumed, can you optimize it, what does that mean from consumer habits, and so on. And this is just a huge amount. If you talk about the transport sector, the transport, just where when the transport infrastructure is consumed by consumers, is now monitored. Data is generated, data is transported, data is stored, and data is analyzed. And with self-driven cars, this will only going to increase exponentially going forward. So infrastructure itself now generates a lot more data.
And infrastructure can be anything. I mean, we just touched upon there regarding electric cars. I mean, obviously, the charging networks and everything around that infrastructure, even that's starting to unfold. Do you see many deals in the future? I mean, I'm assuming that market's been picking up. I know it's challenging to build that charging infrastructure. But do you see some good opportunities for that in the future?
I think it's happening already.
Okay.
Right? So I think if you look at the volume of EV charging deals this year, I think it's probably double the size of double the number of deals last year. And last year was probably 2-3 times larger than the year before. I think where investors need to be careful is to analyze some of these business models, because historically what we have seen is that when you combine merchant revenues, and this merchant component is not only relevant for the power sector, renewable sector, but it's also relevant for other infrastructure assets. So when the price per unit is not fixed, and also the volume is not kind of guaranteed and fixed, then it starts becoming a bit more risky than what investors tend to be used. It's a good question what the infrastructure is, right? So I think some of the pioneers of the Core Plus.
Do you feel that infrastructure has grown too many legs and suddenly it's almost everything? You can kind of put an infrastructure hat on so many different things now. Has this sector, I don't know, has it gone off on too many tangents?
Well, I mean, it's a great question, right? And this is exactly what I was...
difficult, and that must be very, very difficult for you guys as well. You're advising on these large scale M&A deals, and I'm sure IDCM being so well known, lots and lots of clients coming forward to assist. You must have to sometimes scratch your head as to whether it is infrastructure. What in your, over the last sort of 12 months, what have you been approached with where you've really had to sit back and think, is actually this infrastructure?
I mean, what I would say about this question is that what I was trying to say, that the pioneers of the Core Plus space, the guys who expanded the definition of infrastructure, and I don't want to call any names because I'm almost certainly going to offend someone by not including them in this group of pioneers, but the funds which expanded the definition of infrastructure, who have been also successful, they didn't do the expansion at the cost of performance, they have a very strict definition or criteria of what is the infrastructure and what is not infrastructure. And usually what this includes is it needs to be critical service to the society. So, for example, medical labs, is this infrastructure or not? And it does meet the criteria that it is critical, especially with the aging population. But then how certain the cash flows are, how contracted, and how volatile the cash flows are.
Yeah.
Is it capital intensive? Which is quite important, because you don't. There are some businesses which may meet the first two criteria, but they're more service based rather than capital intensive business, and usually the service type businesses are not infrastructure. So is it capital intensive? What is the EBITDA margin? Usually low EBITDA margin businesses are not defined as infrastructure, and you don't need to have 90% EBITDA margin. Some of the district heating companies have EBITDA margin as low as 25%, but they meet a lot of the other criteria. And overall, what are the barriers to entry, right? So you do need to have some kind of protection. You don't need a monopoly like as a regulated utilities back in the days, or a road. Usually people don't build a parallel road. A road is usually a monopoly. You don't necessarily need to be a monopoly these days to be an infrastructure asset, but you do need to have some kind of barrier to entry, and this could be a technological advantage, economies of scale, or some other form like of contractual protection that allows you to be, which prevents a competitor to enter your market.
And this is quite insightful as well, because a lot of this is probably the way that you kind of conduct your diligence on some of these deals. What I wanted to ask you, because I appreciate we're kind of coming up to running out of time now. I know you've got a lot of things on today, but where do you see the next 12 months for the infra and renewables market? And when I ask that question, I've also got the thought in my mind that when I'm speaking to professionals, not all of them, everyone seems to be saying, it's been really difficult to raise finance.
Yes, and I had a discussion about this with some of my clients and peers. And look, I'm not one of the pioneers of this industry. There are people who have been around a lot longer than I have been in this industry, but I feel like there's a much larger number of infrastructure professionals who started their career after the Great Financial Crisis, and who have only seen the market when interest rates were zero or close to zero. But the previous 40 years before the Great Financial Crisis, interest rates were not zero, or not nowhere close to zero. So to a large extent, we're now living in a market environment which is very different, that most of the infrastructure professionals have experienced during their career. But for some people who have been around for slightly longer than that period, they know that this is actually the more of the norm. This is more of the normal market environment. Unfortunately, I think there will be a period of time, which probably is going to be this year, probably will take some time of next year, that everyone needs to adjust to this, what it feels like it's a new norm, but it's actually what it was, the normal environment before the Great Financial Crisis.
So what you're saying is there's been a bit of a shock to the system.
Correct.
Because and we've had, I suppose, sort of 8-9 months of it. I know it's been raising incrementally. So therefore, what you're saying is that lots of anyone looking to invest has probably been holding their breath, adjusting to this new normality. Do you think that 9-month period of shock is over now? And do you now see more investors coming to the market? Are your clients now saying that things have softened and it's maybe becoming easier to raise finance? Or is the next 12 months going to be rocky again?
No, I don't. I mean, I don't think the period is over. I think the next 12 months will be rocky again. I think up until now, there was no desperate sellers of assets, right? So people could afford to hold on an asset for another 12 months. The more pressure we see in terms of people having pressure to sell assets, or developers to raise capital to develop and fund their projects, otherwise, they'll miss certain deadlines. The more pressure builds up, the more sellers or people who need capital will need to adjust to the new price realities, right? So at the moment, we're at the beginning of a period of time when there is a mismatch between value expectations from sellers and buyers.
There's actually, yeah. So there's
And I
actually
think this will take a bit of time to kind of reach equilibrium. Until we reach equilibrium where kind of the new reality is absorbed in people's perceptions, I think we'll see deals failing, deals not getting done or taking longer. But once people adjust to the new reality, then we'll see, both increasing capital raising, but also increasing the number of successful deals, because we're not struggling in volumes of deals at the moment. We're struggling in volume of signed, closed deals. That's what the industry is currently suffering from.
No, absolutely. It is interesting, but with every market, as you just mentioned, then there's certain projects that are not at a discount. We won't say that, but there is certainly opportunities. One thing that I've always thought about is that lots of growth in this market we've seen from pension funds coming in and setting up their own renewable energy investment vehicles, or at least putting the capital into them. Do you feel now, because a pension fund is all about lower risk, isn't it? Providing they can keep that return. I'm pretty certain that if you've got large amounts of money sat in a bank, in these funds, you can probably get very high interest rates. Do you think that the market's going to suffer because perhaps some of these large pension funds no longer see the need to go into that risk and start investing in these assets?
Well, I mean, the counter argument to this argument is what is riskier? A government bond, which you probably know what the performance has been, especially for the UK pension funds, is an investment in a government bond safer than an investment in a private infrastructure investment vehicle, which doesn't have the same type of volatility on a quarter-by-quarter basis. I personally think that what has happened in the last 9 to 12 months would result or should result in more appetite for pension funds to invest in infrastructure than in low yield government bonds or other fixed income instruments, which are, as we have seen, to a large extent highly volatile to the government policies or Bank of England or Federal Reserve policies. So the one thing you need to understand, or your audience needs to understand, is that the need for investments in infrastructure will not change, and this capital needs to go into infrastructure if we are going to meet our 2050 targets. And the only question is where this money is going to come from, right? So I don't think we'll see slowdown in investments. I don't think, and not just in renewables and transition, but also in digital infrastructure, transport. I mean, transport sector would need to, it is still to actually bubble, because all our ships needs to change to technology which is using low carbon fuels. All our airplanes, aviation needs to change. A lot of the ground transport would need to move on rail rather than wheels. So
although you see lots of transport companies building out electric bus fleets, etc.
Sure, but I think we're at the very beginning of this.
And COVID probably had an impact on that as well, because lots of their revenues have been significantly down, which has been a real shame, obviously. So obviously for these transport companies to start investing in new fleets, it's a challenge. But with that, there's obviously another investment opportunity there as well.
Yes. Yeah, this is exactly what I'm saying, right? So we as a society, we as a planet, will need to make these investments in the next 30 years. And the fact that a few pension funds have suffered some losses in the last 9 months, this is not going to change the overall trend.
And that's an interesting point, isn't it? Because this is infrastructure renewables is a long-term play, and short-term losses, they won't stand the test over a 10-year period.
Correct.
What you've explained to us today has been invaluable, Martin. We've looked at how the market was. We've looked at how the market has evolved. We've looked at the trends. We've looked at the opportunities. But all in all, I think what we can get from this is that the infrastructure and renewable energy market across the UK and Europe still remains incredibly buoyant, and there's still some fantastic opportunities, maybe even better than they were to get into this space. You talked about pioneers. In my opinion, you are a pioneer for the future, and IDCM is a firm that, as you know, I hold in incredibly high regard. The work that you're doing and some of the deals that you're involved in, with you on the M&A side and Justin May on the debt side, have been amazing. We've talked about other advisors during this conversation, but for me, I think IDCM offer a really personal approach to these kinds of deals, and I'm sure anyone listening who is looking for debt or M&A advice across this space can get in touch with you, via the website, etc.
And just to make a point on this one, Macquarie DC, I don't necessarily see them as competitors. That they are partners. I very rarely compete for mandate with the larger investment banks. We float on the kind of the smaller mid-market segment, where I think the Macquarie and the DCs, the Evercores, the Rothschilds, they're targeting the larger size deals, north of $1 billion, $1.5 billion type deals. We tend to do the smaller deals, and we very often are on the buy side of the deal, where they're on the sell side.
And thank you for making that that important comparison as well.
Yeah, I personally, have very high respect for my previous employers, and I think they're doing well, and they'll continue to do well. But I think IDCM has identified a niche in the market which is quite unique. We help a universe of clients which we believe are underserved by the larger investment banks, but we do provide the same level of quality and service as the larger investment banks, which is not provided by some of the smaller, big four, let's say, or some of the other smaller investors. And to that respect, I think we are quite unique, and we occupy a niche in the market which which is quite interesting. And we see much larger deal flow in that space, to be honest.
And that is, and thank you for explaining that as well, because I think there's a distinction, isn't there? You know, different advisors look at different deals, look at different size deals, but that's IDCM's sweet spot, and I think there is definitely a gap in that market, and I would see IDCM as the leaders. Martin, it has been, as always, an absolute pleasure. I think we could probably talk on for hours on end, and I think I'd love to come back to this, but thank you for your time, and thank you for coming on the show.
Thanks, Daniel.